It's Sunday and it's showtime. I want to thank everybody for coming. The questions this week are much more about the concern for the future, and that impacts everything: jobs, real estate, and so much more. Also, a super question about money and Bitcoin. Can Bitcoin be money? Interesting. And so much more. The crazy disruption coming down the pike, fit, fast, and furious. The question is it really coming? Second question is, how severe will it be? And the third question, when? And how do we prepare? So let's get into it. A big thank you as well to Sean D and TD and K8, all for coming. Let's get into it. This one's called Bitcoin Dead End. Don't worry, it's not that ominous. And this is always not financial advice. We'll also talk about options as well. A lot about leaps. Everybody's excited about leaps. I'll talk about some of the leap secrets that come as well. And all the questions come from Patreon. Thank you, everybody in Patreon. This first question really got my attention. This is from Rock Oil Guru. Does this characterization of Bitcoin have any validity? Total world currency is less than total GDP. True. So the remaining value is comprised of debt. In fact, more. A lot more. The whole world is built on debt, mountains of debt, far more than money and GDP. But we'll leave that for now. Bitcoin is deflationary, so its value goes up with time. Technically, Bitcoin is inflationary, but because people lose so much, you could argue it's deflationary. Again, we'll leave that there. But your interesting question is, therefore, no one would ever borrow Bitcoin because it would be more expensive to pay back the loan. So there would be no borrowing, no bond market, no reserve currency in Bitcoin. So it's a dead end. Brilliant question. I love these questions because they make me think hard about exactly how this stuff works. So I've got three ways of answering this. And I hate to be wishy-washy. I like to be black or white, yes or no. But this one is a little bit gray. And let me explain why. This is the simple answer first. You can borrow in Bitcoin the same way you borrow in dollars. But if Bitcoin is expected to rise in value, lenders can technically set negative interest rates as you pay back fewer coins or structure loans differently or more efficiently. People already borrow assets, for example, a change in value, like stocks, gold, real estate. It just requires adjusting terms. And debt markets don't disappear. They will change and adapt to whatever is out there. Now, there are two sides of the coin. I'm taking this from a pro and con perspective. And it's all a question of what you do with the Bitcoin you borrow. If you're borrowing Bitcoin and converting it into fiat and then converting it back to Bitcoin later, that could be a bad trade. But let's talk about the pros of why you might be right. This is the problems of Bitcoin as money. It is harder to borrow if Bitcoin keeps going up, as you say, and economies need credit and debt to grow. If there's no borrowing, there's no bond markets, and history shows as well, deflation does freeze growth. But technically, Bitcoin's not deflationary. And people might hoard instead of spend, which also has an impact on money. Remember, the US government could not waste as much money as they waste if they couldn't borrow. Remember, the US government, for every $4 they spend, they create $1 in value. They are the worst capital allocators on the planet. We'll talk more about that too, and some of the new changes that are coming to the world as well, what I call UBI nation. But this is the opposite. That was the pros, which technically could be cons. These are the cons, which technically could be construed as pros, but why it still could work. So Bitcoin-backed loans already exist. Yeah, but people borrow against their Bitcoin to buy fiat, but they don't have to repay in Bitcoin. Bitcoin is just the collateral. And growth isn't only from debt. It could be, we'll talk a lot about this today, could be from AI and infinite abundance through all the effectiveness and efficiency gains we get from artificial intelligence. It's possible too, not just by borrowing. And Bitcoin can be digital gold while others handle credit, for example, stable coins, etc. All that could be handled there. And deflation doesn't always kill spending. It can hurt, it can delay decisions, but not all spending. And finally, Bitcoin and fiat can coexist. Case in point, El Salvador. So it's a brilliant question. I think I will argue with you There are ways of working around it. You just need to unthink the way actually money works today to flip it into Bitcoin. So I think, yes, you can. Bitcoin is money. Bitcoin is better money. And that's what makes it difficult to wrap your head around because you're used to such debasing fiat. But on to the next question. This is from G. Vagnati. Sounds Italian. First, your insights helped me put 2 kids in U.S. colleges as a widower. I'm very sorry for your loss. And congratulations on the 2 kids in college. I hope you realize how much you and the team have impacts on people's lives. I hope so. The 7 days working week is working. So thank you. And please continue. I can't continue forever. I can't do 7 days forever. That's for sure. That's going to stop. We'll try to get to this bull market and then we'll figure out what we do next. But my question is about the impacts of AI, and is it a bit theoretical? Given that the AI's revolution is coming and the loss of jobs are going to be widespread in the next few years, how do you think it will impact the real estate market? For example, why would we need San Francisco or New York City with crazy, concentrated, and ultra-competitive real estate markets if suddenly a huge chunk of those high-paying jobs are gone? This one also made me think a lot because I also dabble in real estate. In fact, my whole story is made money in the markets, invest in real estate. That was kind of where I parked the money. I always have these cycles of where I park money. And that proved to be a very good leg of the 4-legged table or stool, wherever you want to talk about. But let's talk about the impact on jobs. And again, this is not my data. This is data from many different sources. And I'm just going to rattle off some numbers. 85 million jobs are estimated to be displaced by global AI and automation by the end of 2025, according to the World Economic Forum. And by the way, not a fan of the WEF, but their economic studies are pretty good. I have to give them that. So far, people estimate 2.4 million jobs in the US were impacted by AI-driven automation between 2020 and 2024, and at least 1.1 million so far this year. Administrative data entry hiring is down 45% since 2022, and this is all considered to be caused by AI deployment. The Goldman Sachs research report says 18% of global workforce could be automated by AI, affecting 300 million jobs around the world. AI and machine learning job market continues to grow, with demand increasing by 41% year over year. And this offsets some of the losses. So there is growth, especially things like data center creation and AI jobs. And 48% of US firms using AI are planning to use AI to cut headcount in 2025. Every CEO in every company in the United States is talking about AI, but they're not talking about it how they can make a more abundant future. They're talking about how they can cut cost, which means reduce headcount. And that is the reality from 8 different sources. Not my information, but pretty credible sources. Now, your question back to real estate, which also is super interesting. I do believe it'll be brought into 2 tranches. And I'm going to break it up into what I call AI cities and non-AI cities that are expensive but have a lot of white-collar jobs. And we saw a massive change during C19. But when I talk about AI cities, I don't mean just San Francisco, but I mean maybe parts of New York City, Austin, Boston, Seattle, etc. I do believe they will remain competitive. There will be a high demand for AI staff and other people, and there'll be a lot of capital deployed, and there could be growth in keeping these people, AI trainers, startups, etc., money flowing in big cities, keeping demand for real estate high through 2028, maybe through 2027, probably 2028. So the next 3 years, 4 years could be good. 2025, 26, 27, 28. So 4 years, fine. After that, medium term, after we get to AGI, ASI, etc., this is the tipping point where I believe there could be mass displacement. All those people that were attracted to jobs and startups will no longer be required because AI could be self-sufficient. And this could create a lot of mass displacement Migration will surge. People will go to maybe take their money that they made in AI and go to more rural areas that are cheaper, and real estate will tank. We are already seeing cities like Bangalore now are seeing early signs of tech job reduction, which is affecting housing. Hard to believe it's already happening in India. And we'll see if that hits these other cities too. But more near term, I am much more concerned about those cities which have a lot of white collar workers that could be impacted by AI. And we've already seen, like in the Bay Area here, huge corporations, massive ones, Tesla's, SpaceX, Oracle, Schwab, so many I can't even mention. Twitter, they've all moved their headquarters out of California, okay? And it's crazy to see, but these movements actually do displace workers. So I do worry about this. This is the non-AI, white-collar, job-intensive cities. You could argue New York has part of that too. A lot of New York companies have moved to places like Florida during C19, but now there is some AI money going there, but not enough to support a city that size, in my opinion. And I fear that by 2030, some cities could look like zombie markets. And we've seen blight and abandonment happen in places like Detroit after the auto decline, which we'll talk about later as well. And another key thing that happens too is when the big money-making jobs leave, the tax base dies. This is also what happened in California. All the billionaires left. Gone. Newsom's there saying, where's our surplus gone? Where's our tax base gone? It's gone. Corporations gone. Rich people gone. Tax base gone. And then it becomes a socialist utopia, which is not exactly a utopia. And I will be spitting some hard facts today, so I'm just a guy on the internet, but this is the stuff that I pieced together in my little brain. And I could be completely wrong as well. But this could be a problem. If the tax base dies, it'll force cuts in schools, infrastructure, and services, and it'll cause people with any money left to leave and go somewhere else. And this means the government may take over cities, what I call UBI Nation. For example, what Mamdani plans for New York City. What does he have planned for New York City? Well, I'm not in New York City. I don't know Mamdani, but I do read. And this is from Tony Lane. He said, this is Zoran Mamdani's housing plan, which he has said out loud. Seize private homes, turn them into public communes, all in the name of guaranteed housing. Goodbye property rights. Hello government roommates. This isn't housing reform. It's socialism with a smile. And this is what the people are voting for. Okay, this is the tipping point. Once half the people are dependent on the government for food stamps and housing and money and all that type of stuff, they will vote for people that promise them more. And that's what we're seeing. We've seen David Friedberg very alarmed about this too. I don't know if it's going to happen. I hope not, but I have a feeling it probably will. And enter the Godfather of AI. I wrote a piece on this on Patreon yesterday or early this morning. I can't even remember. It all bleeds together. But this is the guy that knows most, Geoffrey Hinton, an English fellow. Shout out to Team UK. He believes companies, the big ones, especially that embrace AI to automate jobs, everything from customer service to knowledge work will be eliminated. And this automation could remove millions of jobs, especially middle-class ones, what I call the white-collar cities. And the owners of this AI technology will be the wealthy corporations. They will see enormous profit increases. And that's my thesis. The elite will get richer, and the majority will see wages stagnate, benefits shrink, or lose their jobs altogether and become part of the UBI nation. This is happening now. This is why I make videos every day. I've been ringing the alarm bell for many years now, but now I'm ringing it even more with a crazy sense of urgency. So thank you for the question. That's what I see happening. AI cities will last longer than the non-AI ones. The white-collar, non-AI, non-tech centers will get hammered in terms of real estate pretty quick. And we've seen this happen before. Look at, I remember looking at real estate. There was beautiful Victorian homes in a place called Detroit selling in mid-90s. get a beautiful 4-bedroom Victorian home in Detroit for like $30,000. And I'm like, wow, that's attractive. Except for the weather isn't and the crime isn't. But anyway, that's some of the downside of that stuff too. We'll see. Again, I sincerely hope I'm very wrong about this and all the experts that I've quoted here too. So let's move on to the next question. And there is a way out. I'll start spreading some ways that we can save ourselves and protect ourselves in the future. This is from Micro Satoshi. I love that. I am a medical researcher and my job relies on getting grant funding to do projects. I'm worried that I might be out of a job in the next 6 months as the current funding for my position is running out and getting the funding renewed is looking difficult. I'm going to tackle that piece first before we get to the other piece. I know a lot of people in the academic field, in the medical field, people at Stanford, UCSF, Davis, etc. And all across the board, funding has been cut, badly impacted by the current administration. There's a whole bunch of stuff here. I won't go into it as well, but a lot of universities and projects relied on NIH funding or other government funding. That's all been stopped. In fact, our head of research has a son that is also dependent on this type of funding to pay for his postdoc schooling. And that's a problem. That's now in jeopardy. So everybody, if you are living off these types of grants or funding, be prepared because it could dry up. So let's get to the second part of the question. I've been using the rotation model. Thank you for developing this and making it available to the community. And I was wondering if I could use the rotation model to generate a regular income stream. And I've been working with the company for a long time, so I get a decent redundancy package with long service leave, balances 75K, which I could use towards the rotation model. Would it be feasible to generate a decent income with this strategy? If yes, which assets would you pick to generate an income stream? And I'm looking to evaluate if this could be a feasible option. Really appreciate all you do. So let's tackle a couple of things. We do have a very big session on Monday to talk about a lot of this stuff as well. But first of all, grants, I cover that, skip that. The rotation model is a very different animal, okay? It's designed to build a very large bag, okay? It focuses on things like compounding over cash flow, all right? It targets capital appreciation, not income. It wants to help you pair trade on steroids across 5 different assets at the same time, but not rotate in and out of things to generate income. That defeats the purpose of this. Every model has a very specific purpose that it's built for, and this is built to anticipate capital flows and will sell things when they're overheated and buy things when they're relatively cheap and be in winning assets. So that is the rotation model. What you probably need is the two ones. If somebody held a gun to my head and I was going to prison and all I could do was trade and use one tool, I'd use pair trading on steroids for inversely correlated pair trading. Very volatile assets. Think crypto. And you can see here, Mr. Krabs, I'm blown away. Almost feels like I'm cheating. And from AW, shout out to Mr. W. Since the release of PTOS, I've used it solely on my 401k, which is now over 7 figures. And I will continue to use PTOS on it going forward. So remember, this is for inversely correlated assets. The other option, which is probably an easier option if you're not that much of a inversely correlated pair trader, would be IADSS for covered calls. And again, it's a game changer, especially to identify the time at which you sell a covered call to make your money. So look carefully at those two. That's what I would recommend. And tune in for Monday session too. We'll break down exactly how and why to use all these different things. Next question is from Bricklayer. James and team, your Patreon is the greatest investment of all time. Regarding synthetic longs, what is the risk of the short put leg being exercised before the expiration, forcing the purchase of the shares? With a leap out 2 or 3 years, if a black swan dumps price in the first few months of a trade, you can be forced to buy the shares prior to put expiration. Very, very, very good point. And yes, selling puts is dangerous, but there's a couple of rules I like to adhere to and try get it right at least 80% of the time. First of all, I always sell puts at bottoms or when I'm 80% sure the upside is here. At least I can weather a storm over a 3-month period or something. But medium term, we're going up higher from where I sell the puts. And I also sell puts in high mean reversion spikes to the downside, preferably 2 standard deviations. So the premiums are juicy. And what I mean by that is you can sell a put. Imagine the strike, say Tesla's 200 or some other asset. You sell that put on a big spike down. And if the volatility goes away, the premium, imagine you get $100 premium for selling that put. If the price even stays there at $200 and doesn't do anything, the volatility goes away, that put actually goes down in value. So you actually make money by it being constant. And that's why you sell it on big mean reversion spikes to the downside. And in all the time I've been selling puts on Tesla since 2017, I have never been put the stock. Okay. And that's a pretty good, nearly 8-year track record. So, and yes, black swans are always possible, but I haven't had an issue with it so far. We'll see if that changes. And I sell a lot of puts on Tesla. A lot. Next question, which is kind of related from Tanti. Hi, James. I have Tesla Leaps. I bought deep in the money, at the money, and out of the money. All over the place. You got to revise that strategy. Cost per contract ranges from 8,600 to 13,850. I have not stuck to your suggested 50% extrinsic. It should be intrinsic time value split, mainly due to lack of understanding as to how and why that works best. Can you please explain mathematically why and when converting Tesla Leaps to shares would be optimal and when it does not make sense economically, as opposed to selling the contract or rolling it? Thank you for all you do. It's the rolling piece. Sometimes you can do that if the trade goes against you. You can roll down, get a lower strike. But let's just examine one little trade from Monday. I did it about 4.5 trading days ago, and we'll look at some of the numbers here. Kind of makes sense. This happened, again, Monday, halfway through the market day. My fill price in Tesla stock was 328. And as you know, I've been stacking Tesla hard. Tesla quickly jumped to 350 in less than 5 days. And I had a leap position. You all can see the trade and how I did it. My leap option is already $50 in the money. My leap is a $300 strike out to December 2027. And I mixed it with something else to make it special. But this is the key part here. The $22 move in the stock from 328 to 350 is only a 6.7% gain. But my SL option leap has doubled. Okay. Because the put has gone down in value and the leap has gone up in value. So the actual value, if I sold it today, I'd double my money, and I did it for many contracts. Now, let's add some numbers to this to put the math around the whole trade. The cost to buy 100 shares of Tesla, say at 350, is 35 grand. Gain is about $2,200 in profit, 6.3% or 6.7%, depending if you bought at 328 or 350. Let's just take that as a percentage of return. With my option trade, it's 100% in a week. And that's 16x the efficiency compared to holding stock. That's why I trade options primarily, because they're juicy. And why it's extreme leverage. And this is the key part. So I play these things with a long-term view in mind. I want to use exposure leverage to bag as much Tesla as I can with minimum cash outlay. And let me try to explain this with some numbers too. So instead of spending 35 grand on 100 shares, I spent 3,500, 1/10 to control 100 shares. 10x less capital, same upside exposure. And if Tesla goes to $700 by 2027, if I just bought the stock, I make 128.5%. And by the way, I expect at least, but at least $700, probably 1,000 or more by that time frame. But just to give you a sandbag number, my option trade, the net value, if we do go to 700, will be $415 a share. 100 shares is 41,500. My outlay was 3,500. So my return is 1,100% versus 128%. That is the extreme leverage that I use with leaps. And that's how they work. And for all my leaps, the next question is I rotate them into, guess what? Stock. All the leaps I've been buying for Tesla since 2017 Every single one of them has been converted into stock. So this one is kind of related to. Thank you, James, for your incredible insights and dedication to the community. I truly believe InvestAnswers is the best educational forum out there. Woo, thank you. I know nobody works harder than me, so I try my best. Thanks to your guidance, this is my first option purchase. I currently own around 800 shares of Tesla in addition to the contracts. I have a question regarding my December 2027 Tesla calls. If they end up deep in the money, which we expect they will, what will be the optimal exit strategy? I'm considering letting them expire, exercising to take the shares. Yes, make sure you have margin to buy them at that time. For the strike, you have times the number of shares. So, for example, if you have a $300 leap, which you probably do, which I have a lot of, you would need 30 grand to buy 100 shares. Now, selling the contracts within the last 6 months of expiration, ideally during a volatility spike to capture both the intrinsic value and the remaining time premium, what would you do? This is an interesting question. Again, I did a little bit of a spoiler. I let them all convert because I want to build a position. Because I know sometimes you have to hold a position for 10 years. By the time my $300 leaps expire, I'll be in Tesla for 11 years, doing the same thing every year, year in, year out. The further it dips, the more I buy. So I like to build a bag on the cheap. That's why I do leaps, as you've seen from the previous mathematics. It's a long-term hold for me. I can't find another company I'll say this again, in 35 years of analyzing stocks, I've never seen anything remotely like it in my life. Nothing. So many paths to so much revenue and profit and margin. It's insane. Also, when I convert my leaps into stock, I don't pay any taxes. I just buy stock cheap. There is no tax event, even though you've made money on your leap. And for example, the other thing that's killer about these leaps is this is an actual case. We had a 5-for-1 stock split in 2020 and a 3-for-1 stock split in 2022. And guess what? I had leaps when I bought my Model X in 2019. Was it 2019? 2007? I think it was 2019. Yes. I bought, like, literally 2 days after buying the car, I was like, this car is amazing. I'm going to buy a truckload more Tesla leaps. Anyhow, I did. But those leaps, right? They became deep in the money leaps. But then the stock split 5-for-1 and then 3-for-1. So my $100 strike leaps became $6.67 leaps. And the price kept on going up. Okay. First split 5-for-1. The new strike goes from $100 to $20. And the second split 3-for-1, the strike goes from $20 to $6.67. Bonkers. You basically pay pennies for these things. And I expect Tesla to split at least once before 2027. That's also the power of these leaps. Just hold them. You're like putting it's a call option on the future of Tesla price, but you're putting a kind of reserve on the stock on the cheap before it goes to the moon. And that's how you play it. So, and it's great. There's been so much EDS out there and everything else to allow us since early 2023. Yeah. To bag so much Tesla. Or I think it was very late December 2022 or January 2023. We had $106 Tesla. It was a beautiful gift. And everybody saw exactly what we did back then. Anyhow, that's what I do. And my goals are not your goals too. Next question is from Clayt90. Hi, James. Why is your Solana allocation significantly lower than that of Tesla? While in the short term, all season could bring up the price of Solana way faster, given we anticipate the negative sentiment of Wall Street around Tesla could go on longer, wouldn't it be better to allocate more to Tesla after all season? So for me, it's difficult because I have a thing called taxes to take care of. And that prevents me from moving money around. I do have retirement accounts that I'm building up pretty fast, but tax-free trading is hard for me. But let me give you a little bit of backdrop regarding my Tesla and my Solana. I've been stacking Tesla with leverage, with leaps and options since 2017. So my position there is already very large, and it takes a lot to move the needle. By contrast, I started stacking SOL only in 2021 and mostly spot. Okay. So Tesla exposure, heavy option leverage. Solana exposure, mostly spot, maybe 1% perp leverage. And therefore, it's hard. And also for me, I face taxes, long-term capital gains by selling. If I sell and get smart and reallocate, etc., who knows where it would end up. But I do want to say, though, I view both Tesla and Solana as drastically undervalued at today's levels. They're both on the cusp of something great, but it's very hard to know over a 12-week period how much each will pop. Tesla has extremely strong fundamentals long-term, despite Wall Street negativity, and Solana has faster potential upside in all season, but we don't know. We don't know where the money's going to go. We don't know if the ETFs are going to be approved. We don't know if alt season or banana zone is going to happen. These are questions. Therefore, I keep my allocations. Okay. And my Solana position is nearly the size of my spot Bitcoin position, which is I've been stacking since 2017. So to put that in perspective, I just started bagging the Solana one, and it's pretty much the same size as my Bitcoin one. So that's how it is. Let's look a little bit at Texas too. This model is available on Patreon. It's your tax break-even calculator. And I threw in some hypothetical numbers here for Bitcoin, Tesla, and Solana. Imagine your cost basis for Bitcoin's 12 grand, Tesla's $65, Solana's $18. And what happens if you have one Bitcoin, 1,000 Tesla shares, 1,000 Solana shares? If you sell and get cute and you're paying short-term taxes, okay, you will need the price of Solana to go from where it is now, $202, $203, down to $128, break-even price to buy back in. Tesla would have to fall to 236, and Bitcoin would have to fall to 71,400, which coincidentally, by the way, I believe if there is a bear market, 70,000 could be the floor for Bitcoin price. It's funny how these things, right? So even if you sold and were cute and took profits and were susceptible to short-term capital gains, of course, the timeline of these asset buys are different, long-term gains. I have that here below as well. If I got cute and sold Bitcoin, I'd have to re-enter at 91,200. Tesla re-enter 293 and Solana 165. We may never see those prices again. Therefore, it's dangerous to be too cute and rotate, although I do believe in rotation, but rotation after exhaustion when you're jumping to a faster horse. But for me, in my tax jurisdiction, short-term trading between assets is murder. I can't do it. I'd be a very different trader if I lived in a tax-free jurisdiction, though. It would be bonkers. I'd just be on PTOS the whole day. I'd have PTS from PTS. PTSD from PTOS. Sorry. Long week. Actually, it's just a continuous week for me all the time. Never a day off. Anyway, oxymoron. Great name. Hi, James. I understand that soon AI will dominate a lot of trading arbitrage, making it much harder for us retail investors. How will AI take the leap of faith that is often required early on assets? Things like Tesla or SOL still getting ignored by much of the mainstream as they do not think long-term. Why would AI do this any better? And could this actually be an advantage for us if AI just copies the current trading behavior? Thank you for all you do. I love the way you think. Yes, this is exactly our edge. We covered a question similar to this last week, but this is as a different flavor where our edge is. And I'll kind of hammer where AI will win and where AI is weak first, and then where we have the opportunity, everybody. AI is not going to destroy us, at least from a trader investing perspective. It will impact some of the stuff that I've grown up doing, like arbitrage, but AI will dominate short-term trading, day trading, arbitrage, all that type of stuff. It'll scrape data, find mispricings, by the way. I also find things like options mispricing. I think market makers and options will get smarter and clever. They'll use AI, and I won't be able to do that anymore either. I won't be able to play the ARB and MicroStrategy, stuff like that. But that's okay. We'll find other things to do. But it's been a dream so far anyway. But where it is weak is in it is trained on historical data and consensus signals, which are often terrible. Remember, if you follow the herd, you will lose. You can't survive following the herd. Its models optimize around what already looks like alpha rather than what's contrarian. And again, I am a contrarian. I use data to find what I call the most hated assets before anybody else. When everybody thinks, oh, you're an idiot, what do you do with that stuff? Yeah. And I just get in early and I wait. That's my method. That's the contrarian. You go against the grain. You do not follow the herd. And AI also struggles with price narratives. It can't understand beliefs. It can't understand cultural shifts. You know, if you talk to AI and say, hey, AI, Bitcoin doesn't pay any dividends, that means it's bad. AI will probably say, yeah, it's bad. So AI can't wrap its head around the belief system that is Bitcoin or the farce that is fiat. Okay, where we do have an edge, though, oxymoron is here, where humans can still beat AI. Again, if we identify mispriced narratives before they hit the mainstream data. For example, you still see today, I mean, like if I talk about, say, AI or Tesla, the YouTube comments, all these trolls come out and say the dumbest things. I just block them from the channel because they don't deserve to watch my videos because they're just so toxic and so uninformed. It annoys me, and I don't want them poisoning any other minds out there. Like, literally, they're either trying to troll me or they have no brain. I don't know which one it is. Either way, I've got no time for it anymore. This is urgent. I don't want good people reading bad, stupid messages. So let's get back to where we are. And yes, shout out to Jordy Visser. He says if he talks about Tesla, he gets one positive remark and 19 negative ones. 20-to-1 ratio of how much hatred he gets if he talks about Tesla. But that's why we like the most hated assets. Retail. Retail saw what Tesla was doing before any Wall Street people could do it. Now we only have one champion, and that's our friend of Morgan Stanley. Nobody else. And Solana was written off as broken after outages. I still see comments, oh, it's down all the time. It hasn't been down in 2 years, okay? It's down because it runs at breakneck speed. It's like going around a Formula One racetrack on a bicycle. Are you going to fall off? No. Going around a Formula One track in a race car doing 220 miles an hour. Are you going to crash? Probably. Sometime. Yes. That's how it works. So this is where humans will still beat. And I'm making it a big part of my focus too, to find things early and play medium-term gains and even hold things for a long time. There's I can't remember his name, some hedge fund manager. He said he's actually held some assets for 42 years and they've made him huge amounts of money. And other people like Ron Barron into Tesla like for 15 years and still holding SpaceX since the beginning, etc. Just sometimes it really just pays to hold and use the miracle of compounding, like building a bag using the rotation model. The whole bunch in there. I hope I explained it as clearly as I can. Next question. Again, another one on disruption. I love this from Stone Trees. Dear James, I pose a question seldom addressed in public discourse. Very fancy. As full self-driving technology becomes ubiquitous and thousands of robotaxis enter service, make that millions, by the way, how many individuals will forgo the burdens of owning a $40,000 vehicle that depreciates and spending over $2,000 a year on insurance, instead paying a modest $1 or 50 cents per mile for seamless on-demand transportation? What repercussions will the shift have on traditional automotive companies, many of which are already teetering on the brink of financial instability? Could this transition prove to be the decisive blow for conventional car manufacturers? It absolutely is. The death knell is ringing loud. And I'm just going to give you data points from just this week. It's such a timely question. Stone Trees? Yes, it is the death knell. Mary Barra sold half her bag, well, 40%, of General Motors because she's driving it off a cliff. And she knows it. She knows it. The cash for stock buybacks will run out soon. And she nailed the top, by the way. Great job on that one. It's basically a zombie company. Unless the government bails out GM in the next 5 years, it will not be around. Okay? It's dead. Dead. And we're seeing German car makers also suffer greatly. And the Ford CEO, Jim Farley, one thing I really admire about Jim Farley is he's brutally honest and very frank. He should have called him Frank Farley because he's so frank. It's turned into a stand-up comedy show today. But he said, Jim Farley, he said the most humbling thing I've ever seen on China's car industry. He talks about their far superior technology lower cost, and fantastic quality. He actually got a Xiaomi car, brought it back to Detroit, and he drives it. It's his driver. Okay. And he knows Ford have no way to catch up. No way in hell can they even get close to what China are doing. They got 200 suppliers that own how they make things. Okay. There's no way Ford will be a software centric vehicle because 200 people make the different electronics for the car with different software and everything else. There's no way it can ever work. And they're not a technology company anyway. You got to be born software first and then wrap the car around that kernel. That's what's needed. Ford are not going to make it. And again, the Xiaomi car, I don't know, it basically talked about how Huawei and Xiaomi are doing probably what Apple did to smartphones, same type of thing. Nobody can match them in cost, quality, whatever else. Anyway, it's dead. But let's talk about FSD and the impact of this. And people say, oh, FSD is fake. I don't drive anymore. I stopped driving at the beginning of this year, pretty much, even before that. But if I'm on a long trip, I do not drive ever, especially if it's dark or it's snowing or raining. The car definitely does all the driving. And I do believe, yes, we're on the cusp of it. By the way, FSD 14 is coming out this month. Probably in, what date do we have? 7th, next 3 weeks. And that's going to be better than your average human. And that's not saying much. A lot of drivers out there on the roads are embarrassingly bad, but it's coming and it's better than a human. And once it reaches 10x better, which could be by the end of the year or early next year, this will become the norm for vehicles. Seamless driving capability. And then we're shifting to exactly what you say, transportation as a service, robotaxis offering rides at pennies per mile, at as low as 25 cents or 50 cents, as you mentioned. And yeah, people will not be buying cars or paying the crazy insurance or the fuel or the maintenance or all the parking. It's just a nightmare. I mean, you want to park a car in San Francisco for like an hour and a half, it'll cost you $30. You can get to San Francisco in an Uber for less than that. Again, the cost of parking has actually killed parking. But it's promoted Uber. But I got a little twist on that too. Coming in a second. Also, this is going to destroy as people buy less cars because, instead of having a 3-car family, they will just deliver their kids to school or practice or whatever using autonomous vehicles, which are safer. There's no rape risk or anything else from the drivers. And that's why in San Francisco as well, you see the Waymos driving around with little kids in the back on their own because it's safe. You don't want to trust your kid to a strange man, but you will trust it to a robot. And that was a big surprise for me when I saw that for the first time about 8 months ago. Anyway, auto manufacturers, their toast. Utilization also will go up huge. So this is a crazy part. The amount of time people spend driving the car is about 4% of the amount of time in any given day or year. That's going to change. That's going to go to 80% or 70% or 60% because you got to charge it, maybe clean it every now and again as we roll into this robotaxi world. And then Tesla's manufacturing, Tesla's cars, even the Chinese. I mean, Tesla sold more cars in Korea than Kia and Hyundai on their own turf last month. Riddle me that. Okay, that's bonkers. Anyhow, a little bit to back up your story. Uber, $13, Robotaxi, $2.61. People say, how is that even possible? Well, to be honest, the price is actually going to lower because that is not near 25 cents a mile or 50 cents a mile. That's $1.60 a mile. But other things too. If you're looking at a Waymo here, it's even more expensive. And this is competition. Robotaxi, $3. Uber, $10. Waymo, $22. Lyft, $11. Boom. That's all you wrote. And they're just ramping up. Okay. And by the end of the year, the safety drivers that monitor things to make sure it's safe. Because imagine if a Tesla Robotaxi crashed. MSM, those people that love to lie, would have a field day. Waymo Robotaxis crash every day of the week in San Francisco, but they're never mentioned in the media. If Tesla was to have one accident, they would crucify Elon Musk. That's what they're waiting to do. And that's why they got these safety drivers. And that's why they're taking extraordinary measures to be safe. Anyway, let's get on to the next question. This will be a fast one. This from Spankyham and NKSB. Love your work. Could you look at this company called RZLV AI? What is the potential of Tether partnership? Recent acquisition of ViSenze. Look, took a small position under $3. What do you think? I've been following RZLV 2. Would be interested in thoughts. So I just look first and foremost at financial risk and growth and prospects. They don't have anything that's special. They have deathly financials. You can see for yourself. Literally, they make less than 188,000 in revenue. Shareholders keep getting diluted. That's how they make the little cash box on the right. And negative shareholders' equity. Tons of debt. Yeah, that's the kiss of death right there. Stay away. Much safer places. And remember always, manage, balance, risk, and reward. You may not be on the fastest horse, but that horse will make it around the track with very good returns over time. But you might jump on a horse that just falls at the first fence, and that'd be terrible. Anyway, favorite part of the week. This week we donated to Save the Chimps to support T, chimpanzee. And T loves exploring his sunny island home and is found wrapped in blankets or hanging out in the hammocks. Yay. Can't wait to get one of those one day. And don't forget Fireside Chat, noon Pacific on September 8th, which is tomorrow, Monday. DCA is on in the morning as well. But for the Patreon folks, don't forget Killer Fireside Chat. Me and Jacob and DCA tomorrow morning with the team. I'll post on that later today too. I hope you all got smarter. That was the interesting story today. I'm going to do some live questions. And a big thank you. Let me try to find them. To everybody behind me and the great mods in the chat too. Sir Winston, is Fig a good buy now? Kathy Wood loaded up some on Friday. Figma is interesting. I actually made a post, interestingly enough, about Adobe on how Gemini, what's it called? Something banana, uni banana, whatever, is going to destroy the creative suite of Adobe and Photoshop and Lightroom and all that stuff. And Adobe wanted to buy Figma over a year ago for 20 billion because Figma was eating their lunch. So the question you have to ask yourself is Gemini 2.5 and Gemini 3 with their, I'm going to get the right name for this as well. I don't want to screw up. It's a cool name, something with a banana. Oh, bear with me. But I made a very detailed post on this a few hours ago, actually, because somebody asked me. Nano Banana is what it's called. Nano Banana from Google. And Google's getting very interesting now with their AI too. But basically, you can get Nano Banana to do anything Photoshop can do at 99% of the quality instantaneously without having any training or expertise. Now, Figma leveraged AI better than Adobe, but the question is, could Nano Banana also disrupt Figma? I personally think that's a safer place to park money too. And IPOs are different. I think Figure, the robot IPO coming, could be a little bit more interesting, but I don't know. And yeah, if Kathy Woods buys something or sells something, remember her goals are not your goals. She's trying to beat the S&P 500. We have different goals in mind. We want to do a lot better than that. Akonda, I do enjoy the live stream. Thank you up there in Sweden. Thank you, Akonda. Metagirl, core versus knots debate, very important. Knot wins. Yeah, this is different. I believe, again, I made a very detailed post on that a few days ago. I stay out of the fray for that stuff, but I do believe it shouldn't be a spam chain. I think poisoning JPEGs with Bitcoin is illogical. Clog it up. There's enough. There's not enough TPS and bandwidth to support what needs to be done. But other people say, well, we need to evolve and attract more users and stuff like that. I think if like with the ordinals, it's a fad. It comes in, it goes out, done. I think it's bad. And Troy Crypto, may you cover the op return debate in a future video? If the 80 billion cap jumps to 100 kilobytes, could it mean illegal pics or videos on chain, forcing nodes to relay and giving governments a way to target node runners? Yeah, I think it's all a bad idea. Troy, there's enough people talking about it, and it's like I don't touch religion for a reason or politics for a reason. But this would be like discussing religion, you know, comparing two religions to each other. You're just going to piss off half the people. So I don't get involved in that stuff. But I did make a detailed Patreon post. I can actually throw that on Substack for free if people want to read it there too. Yeah. And that would be it. It's a tricky one, but I believe in traditional Bitcoin stuff. Bitcoin is there for a very specific reason, not to send monkey JPEGs, in my opinion. Maybe I'm just old. Zola, which tool do you use to trade? My favorite tool is the optimized trend and IADSS, confluence, mean reversion. And if I was a full-time trader, I'd use PTOS the whole time, which actually has optimized trend in it. But I also use rotation model. I use ATR. ATR gives me a very good sense of exactly where an asset is, support and resistance levels, and direction. And I use it all. I created it all, but I use it all too. Well, I created with a brilliant development team as well. That took years to do. And thank you for your super sticker, Forrest, Sieberger, Ragnar, Signal 103, Adam Q, Dancing Shoes, Dog One, and Joe Biden's Daycare. Appreciate you all coming, my friends. I hope I didn't miss anybody. Red Hat is there too. Troy Crypto, Metagirl, Silver Muster, Forrest. Yeah. Thank you all for coming, my friends. I'll see you all tomorrow. Twice, hopefully. And enjoy the weekend. Bye-bye.